Good evening, guys. What have I got here? For you in the back, there's a 50-gram gold bar here. I have a 20-gram gold bar, a 10-gram bar, a 5-gram bar, and 2 pieces of 1-gram bars. So this is 87 grams of gold, all in total. Now, as most of you in here know, we have a vault in behind here. We have a bullion vault integrated with this shop. Now, what if I tell you that every day we sell about 6,000 grams of gold in here, 6 kg of gold every day? And what if I tell you that all customers are actually storing the gold with us? But we are only keeping these 87 grams of gold in our vault. Now, you would try to get me arrested as soon as possible, because you would call this fraud. I'm selling 1.5 tons every year, but I only have 87 grams in my vault. What's going on? This is obviously a Ponzi scheme I'm running. I'm having fractionalized reserves. Now, to be clear, this is not how we do things. When you buy and store with us, you own the gold bars outright. You have full legal title. As all customers in here know, you can physically audit your bars at any time. You can physically withdraw without any prior notification by just walking in here. You have third-party audits by Bureau Veritas. You have a live audit report. You can anonymously see everyone else's holding, everyone else's serial bar numbers. We upload pictures of your bars to your account so you can actually see your gold, silver bars and coins on your account when you store with us. So that's not how we do things. What I just explained is something else. It's bullion banking. And it's bullion banking per definition. And more precisely, it's unallocated gold trading. So as Luke mentioned, over the last 2 days, the LBMA, meaning the London Bullion Market Association, has held its annual seminar here in Singapore. And the LBMA is of great significance to the gold market because it has great significance both in terms of the price of gold and in terms of movement of physical gold around the world. To understand the gold market, we really have to understand bullion banking and how bullion banking is tied together by the LBMA system. So I will try to provide you with an introduction here today of bullion banking and how it's working within this LBMA system of trading unallocated paper gold. Because almost all gold in the bullion banking LBMA system is unallocated gold. To understand what unallocated gold is, we can read on LBMA's website itself, where it says that an account holder of unallocated gold has no legal title, no ownership to the physical gold itself. An account holder just has a mere claim, is just an unsecured creditor to the bullion banks. So essentially, unallocated gold traded within the LBMA system is paper gold. The gold doesn't exist in the physical realm. And the interesting thing is that how paper gold is created in this system as unallocated gold is very, very similar to how fiat currency, our money of today, is created in the fractional reserve banking system. So the fractional reserve banking system of fiat currency can provide a very good gateway, a good bridge of understanding how bullion banking is working, or not working, depends on how you view it. But let's recap and take a look at our monetary system today, because most of you in here, of course, knows how this works already. But how is the vast majority of money created today? Well, the money is created out of thin air. When the bank extends a loan, the money is created. A bank credit is created when it's deposited to the person who borrows the money. So let's take an example. We have a guy here, Robert, he wants to buy a house for $1 million. So he wears his best tie and he walks into the bank and he asks for $1 million, 100% loan on his house. And lending standards are quite low today, so surely the bank will give him a mortgage. But where did the $1 million come from that was extended by the bank to Robert's account? Well, nowhere, because it was created out of thin air. When the bank actually extended the loan to Robert, the money was just created out of thin air as magic. And it was created in the bank's bookkeeping system. So this was just happening in the ledger bookkeeping system of the banks. And this is quite easy to understand, but a lot of people still find it hard to believe that 90+% of our money today is just created as electronic money out of thin air in a bookkeeping system of a bank, or different banks, all banks. But so we have today about 7-8% of our money supply consists of physical notes, bills, and coins, and the rest, about 92-93%, depends on the country, but in Singapore it's about 7-8%, and it's the same in the US actually. But 90+% of the money is just created in this fashion as bank credit out of thin air. Now, how is gold created? Well, surely gold can't be created, it has to be mined, right? And of course, physical gold has to be mined. But if you ask a bullion bank, they would beg to differ, because investor gold can surely be created out of thin air. Paper gold can be created out of thin air. So let's take Robert here again. Now he wants to buy 100 ounces of gold, and he goes to his bank, which is also a bullion bank. The standard procedure for the bullion bank when someone wants to buy gold is to just deposit 100 ounces of unallocated paper gold into the buyer's account. Where did the 100 ounces of unallocated gold come from? Well, nowhere. It was just created out of thin air. So it's just paper gold that's issued by the banks in a very similar way to how banks can create fiat money in the fractional reserve banking system. So we can see that the banking of gold is very similar to the banking of fiat currency. Now let's instead assume that Robert comes into the bank with 100 ounces of gold, a 100-ounce gold bar, and wants to deposit the 100-ounce gold bar at the bank. What happens then? Will the bank safe keep this bullion bar for Robert? Well, if he has an allocated account, yeah, the bank has to. But in the bullion banking system, most of the gold traded is unallocated gold. So what happens when Robert deposits this gold bar is that the bank takes the gold, keeps it on its balance sheet, but then proceeds to either sell it off, lend it out, or allocate it elsewhere. So now the bank has a liability to Robert, but has got rid of a physical gold, so the bank is no longer in possession of the gold, meaning that the gold is double counted, because the bank has a liability to Robert, but at the same time has a claim to whoever they lent it out to or allocated it to, and this can go on in several steps. And of course, the bullion bank has to have a tiny reserve of physical golds, just like a commercial bank has to have a tiny reserve of fiat currency to be able to extend its gold position or extend its money. But this is how bullion banking is working, and not a lot of, as Luke mentioned actually, a lot of focus today is on the futures market, on COMEX, but the London Bullion Market Association and the bullion banks trading on the LBMA system is actually trading much, much more gold than what is traded on the COMEX. So the COMEX is a bit of a sideshow in my opinion, and I will get back to this. But to summarize bullion banking consists of unallocated gold trading. It's basically bookkeeping entries that are traded among different paper traders. It's fractionally reserved, and it's gold created out of thin air. And when you hold unallocated gold, you're just a general creditor to a bullion bank, and you're an unsecured creditor. Now, how much unallocated gold is there in the LBMA system? Well, the LBMA is publishing average daily clearing figures. So the LBMA says that there's about 600 tons of gold cleared every day. But this is not the trading volume, because there was a survey conducted in 2011, actually, where the members of LBMA said that there's 10 times as much gold traded as there is gold cleared, meaning that to calculate the amount of gold traded each day in the unallocated gold system in London, we have to take 600 times 10, meaning there's 6,000 tons of gold traded each day on the LBMA system. Now, to put this into perspective, how much gold is mined annually in the whole world? Annually. It's about 3,200 tons. So essentially, there's 2 times as much gold traded in just London in one day as there is gold mined in the whole world in 1 year. So 6,000 tons per day is a massive amount. It's an astounding figure. And if we look at the whole year, we have about 250 trading days. So that's going to make about 1.5 million of tons traded in the LBMA system in 1 year. What is backing up all this unallocated gold trading? 6,000 tons per day, 1.5 million tons per year. Let's take a look at the reserve side. The LBMA community is keeping 400-ounce bars in reserves. The 400-ounce bars has to be 99.5% plus purity and weigh in between, there's a variance, so they can weigh in between 350 and 430 ounce. But the bullion banks don't actually want to keep any reserves because they look at gold as a dead asset. They don't want to keep it because it's incurring storage charges, handling fees, and instead they want to make it into what they call a live asset. That means lending it out so they can earn interest from the gold itself. Because they just view it as, a dead asset that they don't have any need for. They instead get rid of it and try to earn interest from the gold. So when a bullion bank receives gold, either through a deposit or someone sells it to them or it's lent out to them, they try to get rid of it as soon as possible by selling it off, lending it out, or allocating it elsewhere to, for example, an ETF. And this is interesting because this is really what sets a bullion bank apart from all other bullion entities. We could never do this. We would be in Singaporean jail already if we did this. But this is what a bullion bank do for their business, meaning that they keep gold that they have received on their balance sheet, but they don't have possession, most of the time, they don't have possession of the physical gold. They've got rid of it. They're just having a claim on their own reserves. Now, how much backing is there for these 6,000 tons traded each day? Well, the LBMA is not releasing the backing figure, but we can take an educated guess, actually. So the LBMA is on record on its website saying that there's 6,500 tons of gold vaulted in London. But out of these 6,500 tons, we see the large bar here, the bottom bar, which is the Bank of England vaulted gold, which stands at 4,734 tons. So the Bank of England is a custodian keeping gold to the customers, mostly central banks. They are on record saying that they have 72 customers, mostly central banks, keeping gold with the Bank of England, because historically, England, UK, London has been a safe place to keep gold. In turn, 34 central banks state that they keep gold with the Bank of England publicly. So we know that those 34 central banks, they keep 3,779 tons of gold with the Bank of England. So you can see this large chunk of the left bar here. These are all central banks that are on record keeping gold with the Bank of England. That leaves us with another 955 tons that are most likely held by the 38 other customers, most likely central banks. So it's unlikely that these bullion banks are keeping any gold with the Bank of England, because there's plenty of room for the other 38 customers, the central banks, to keep these 955 tons. So 6,500 tons altogether in London, 4,734 held by the Bank of England on behalf of central banks. That leaves us with this part, right? This is the privately vaulted gold in London, the non-central bank vaulted gold, which is 1,766 tons. There's a lot of, I'm pushing out a lot of figures here, but it's going to be interesting eventually, so bear with me. 1,766 tons. This is the privately vaulted gold. Now, the vaults in London, there's a couple of them. The HSBC vault and the JP Morgan vaults are by far the most dominant. There's also a vault that used to be owned by Barclays, now ICBC, but HSBC, JP Morgan, those are the two big ones. But out of this 1,766 tons, ETFs, they are holding altogether 1,679 tons. When we have started on this, with this figure, 6,500, we have deducted all the gold we know someone else is holding, the Bank of England gold, the ETF gold. We are left with this part down here, which is 87 tons of gold. So the 87 tons of gold we are left with is what's backing up all the unallocated paper trading in London. Now, of course, there can be a slight variance here, plus minus a couple of 100 tons, so this bit might be a negative figure even. But you know, for 6,000 tons traded each day, 1.5 million tons traded each year, 87 tons is not a lot. So we have, again, now we're not doing this well, so I have to represent this 87 tons with 87 grams. So we have, again, the 87 grams of gold that is vaulted in the London system to back up 6,000 tons traded each day, represented at a ratio of 1 to 1 million by these 6 kilo gold bars here. But remember that this is just 1 day's trading. This is 87 grams for 6,000 tons per day, represented by 6,000 grams here, which is traded each day. So I better hand this back first. I trust you guys, you're all good friends, but anyways.
But you're going to give it out.
Yeah, well, yeah. We'll do that later. So you can see, so the conclusion here is that there's a whole lot of gold traded, but there's not very much gold backing it up. There's very little gold kept in reserves. So this sort of summarizes it. You have a 1.5 million tons here again, paper trading, paper fiat currency, and this all comes down to the, well, single gold bar as it is on this picture, but the 87 tons. So all of the LBMA privately vaulted reserves are essentially already allocated elsewhere to the ETFs, and the big chunk of the London gold is also held by the Bank of England vault. So we can understand that the LBMA system is a banking system which is based on fractional reserve banking, just like fiat currency. And as it is a fractionally reserved system, it is per definition using double counting. So like I explained initially, if someone comes in and deposits 100 ounces of gold to a bank, the bank can lend out this gold to another bank. So then it has a liability to the guy who deposited it. Then they have a claim to the other bank that they lend it out to. And then the second bank can lend it out again to a third bank. And then the third bank can allocate it to an ETF. And then the ETF owns the gold outright. So I'm not saying that the ETFs are not owning the gold. They are. But the gold they own have been already used to offset other liabilities many times. So we can see how the same gold is used again and again, many times, being double counted, and therefore, of course, it's a fractional reserve system, meaning that there's very little gold in physical reserves backing up all of the trading. Let's look at the gold vaults now. So like I said before, there's a couple of gold vaults only in London. The largest ones are the HSBC and JP Morgan. At least those are the ones where most gold is held. There's also an ICBC vault. There's a couple of logistics companies keeping gold vaults in London, but HSBC, JP Morgan are the big ones. But there's some 40+ bullion banks in the LBMA system, meaning that about 40 or so bullion banks don't have their own vault, but they still keep books denominated in gold, even though they don't have their own vault. Meaning that if a bullion bank that don't have a vault, for example Citibank, let's say, if they get any gold as deposits, they're going to keep it with one of the other guys. So what happens then is that the bullion bank itself that gets in the gold keeps it somewhere else. They just have a claim on their own reserves. So try to follow this, because this is important, meaning that most of the bullion banks' reserves are just paper claims also. So even the reserves are fractionalized. This is bullion banking per definition. So we have paper assets as reserves, and we have paper liabilities. So that's paper of both sides of a trade. A bullion bank that is keeping reserves in physical gold may not even have the physical gold. It's just paper on both sides. So, which is really, of course, inflating the supply of gold, because this is helping, naturally it's helping to push down the price of gold. A lot of people asking me, are there manipulation of the prices? And I say, I don't know. Maybe there is, maybe there's not. But what I'm telling them is that if you can artificially increase the supply of gold by paper gold, of course it's going to put the prices down. It's going to push the prices down. Because, of course, the equilibrium, the price equilibrium, as it's called in economics, is going to be further down if you can just increase the supply. With bullion banks, keeping all these liabilities of paper gold, they are, just like normal banks, susceptible to bank runs. Because if you hold unallocated gold on your account, you can actually still request physical delivery. So if you guys all have some unallocated gold on your unallocated gold accounts, and you demand to take delivery, the bullion bank has to deliver your gold to you physically. And of course, if enough customers do so, we know that there's very little gold. Remember the 87 tons backing up 1.5 million tons traded each year. If enough people take physical delivery, there's not going to be enough reserves to distribute. So what we can see here is that the LBMA system, the LBMA used to have about 15,000 tons in reserves. It used to be 15,000 tons of gold vaulted in London about a decade ago. Now it's 6,500. So this is sort of a bank run in slow motion, because we can see here in Asia, over the last 5 years or so, there's been an enormous increase in the demand of physical gold. So whereas Westerners are mostly busy with the paper trading, Easterners, here in China and around in Asia, are taking physical delivery of real gold. The difference between the fiat currency system and the bullion banking system is that there's no central bank backstopping, acting as lender of last resort for bullion banking. We know that for the currency system, of course, the central bank is the lender of last resort. They can always issue more fiat currency. They can always lend money out to the commercial banks. The central banks used to be involved a lot more in the gold trading than what they are today. Today they are saying that they have actually stopped lending out gold and that they are net buyers. That's at least what they say on record. So instead, for bullion banking, the ultimate rescue mechanism is cash settlement. So for all unallocated gold trading, if you read the terms and conditions, there's always going to be a clause allowing the banks to cash settle, meaning that if there's no gold, I'll just pay you the cash. So that seems fine to a lot of people, but what is the issue here? Well, if there's no gold to deliver, what's going to happen is that the physical gold price is going to disconnect from the paper gold price, meaning that price of gold is going to be set on physical supply and demand. And if that's happening, the price of gold is going to go much, much, much higher, because all the demand will have to be funneled into the physical market. that is today on the paper market. So a lot of people is going to be settled at perhaps, the level we are now, whatever it is, $1,200 US, $1,300 US, whereas the physical price skyrockets, which is very similar to what happened with the US gold in 1971, when President Nixon defaulted on the delivery of gold to France and some other countries. So you lose out because the real price for real physical gold is much higher than the paper price. Paper gold in the LBMA system, though, is very similar to fiat currency. We have a comparison here. Both are fractionally reserved, and today, I know this very well because I'm Swedish by origin, and Sweden is the worst example of this in the world, meaning that fiat currency in the fractional reserve banking, the banks like to promote cashless transactions, right? So you have in Sweden, it's actually about 98% of electronic currency, only 2% bills and coins, and that is, the best in the world according to the banks, and the worst in the world according to me. But what the banks do is they promote these cashless transactions. Why do they do it? Well, they have handling costs for physical cash. They earn fees from credit cards. They are less susceptible to bank runs if they can get rid of a physical cash, because no one can actually come and withdraw their own money, which it's supposed to be, but they just hold a claim. But they can't keep any checks on the bank because they can't withdraw it anymore because there's no cash. And of course, the bank likes to lock you into their system so that you're all stuck with the bank. You can't have the personal freedom, the personal privacy of keeping cash if you so prefer. So in the same way as the commercial banks are going cashless, the bullion banks are going goldless. So we have goldless gold transactions in the bullion banking system. Why are they doing this? Well, of course, the banks are in it to earn fees. If you are limited to the physical world of tangible resources, 3,200 tons of gold mined each year, well, you can't earn as much fees on 3,200 as you can on 1.5 million, right? So if they can leverage the paper system, they can earn a whole lot more fees. So this is what's in it for the banks. And also LBMA is essentially making their money directly or indirectly on fees. So they are all in bed together. So just like the fiat currency system is incentivizing reckless debt behavior, the bullion banking system is incentivizing reckless creation of paper gold. So they are actually very similar. But the really interesting point here is to think one step further, because when the bullion banks are creating paper gold, what the bullion banks really do is to protect the currency system. Now think about it. What would happen if the bullion banks couldn't create paper gold? Then we would be back again to the physical gold market, and the price would be set, like I talked about, on the physical market, meaning that the price would be much, 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 much higher, because all the demand would have to be funneled into the physical market. What would that tell us, actually? Well, gold for some 6,000 years has been money. And it's still today a monetary proxy, meaning it's sort of keeping the monetary system in check. So if the price of gold goes much, much, much higher, what will that tell us about our currencies? It will tell us that they are worthless. Well, they are already worthless, actually, and have lost 99% of their purchasing power in the last century, but even more so. And will tell us that they are all inferior and due to collapse and to implode. So what the bullion banks really do by using paper gold trading and artificially increase the supply of gold is saving the currency system. The best thing with this, well, you can still buy physical gold very cheap. And if you produce and save, you can save in gold, and you still have time to increase your position of saving in physical gold. Because when the system finally collapses or implodes, as it will have to eventually, the price of gold will have to be set on the physical market, and then it will revalue significantly. So to summarize, the LBMA, the bullion banks and the LBMA system, what is their sort of worst problem? Well, reality is their problem. Reality is the worst problem for a bank. So they try very hard to overrun the reality. Because the reality is that there's 3,200 tons of gold mined each year, but this is something they'd like to disregard. You know, they don't want to be kept in check by the physical limitations of the real world. They like to live in their own world and issue paper gold. So they issue 6,000 tons every day and 1.5 million every year. And promote goldless gold transactions because they can earn much higher fees from that than they could if they were to only trade physical gold. So the LBMA system is based on fractional reserve banking. Physical gold is rarely seen in this system. And you know, once again, there's very little physical reserves, 87 tons for 6,000 tons traded each day. So really the bullion banks are the paper gold protector that protects the fiat currency system. But it is a fragile system because today 99% plus of all gold in the world are traded in this fashion, traded as paper gold in an allocated paper gold system. And when just a margin of investors in this system take delivery, there's going to be shortages. There's not going to be enough physical gold. What we've seen the last 5 years is very interesting because there's been a lot of gold flowing from the west to the east. And if this is sustained anywhere near what it has been over the last 5 years, it's just a matter of time before this system is collapsing because the reserves are diminishing very quickly for the London gold system. Now, there's been a slight rebound over the last 6 months or so, which I think is just a rebound because this is a very significant trend that Asians in particular are taking physical delivery. Easterners are savers. They are not investors in paper vehicles. They are savers and save when they have discretionary income, they save in physical gold. And when and if the system implodes, all the paper gold is going to be cash settled, like I said before, and the physical gold will disconnect. Now, this is a bit interesting because if we look a bit more at the Western investors, most Westerners are not comfortable in investing in physical gold. They want to hold some sort of paper vehicle. They've been, well, brainwashed into this sort of. And they are unaware that they are buying into a Ponzi scheme. So the interesting thing is when a Westerner buys, I'm generalizing naturally, but when a Westerner is buying gold, in terms of buying paper gold, they do so to protect themselves against the fiat currency system. But you see the irony here, right? The systems are all alike, and the gold system, based on unallocated gold, is even worse of a Ponzi scheme than the fiat currency system. So this is the great irony of Westerners. They are buying into paper gold, but they get fractionalized, double-counted gold. So they're buying into something that they sort of protect themselves against, but they get even worse off, which is, of course, very, very risky. So my point here is that the Western demand, you can see that Western demand is always increasing when the price of gold goes up. Westerners are trend seekers. They jump on the trend bandwagon and tries to make a return on their investment. But the Westerners are not really systemically threatening this bullion banking paper gold system. The systemic threat is coming from Easterners, because it's Easterners and Chinese Asian savers that are demanding physical gold. And this is what we have, of course, seen over the last few years. When the price of gold is going down, we, as you guys know, we get a lot of people here in the shop, and we get queues, and there's starting to be shortages of physical gold. So the systemic threat to the bullion banking and LBMA system is coming from real physical gold investors, gold savers, and particularly here in Asia. Fractional bullion banking system is really an accident waiting to happen. And the question is, having just been at the LBMA conference, which is very nice for wine and dining purposes, but there's not a lot of real information released at the LBMA. The question is, why is the LBMA and World Gold Council, the whole bullion bank sector, so secretive and so opaque, and not releasing figures and not educating us on how the mechanisms behind gold trading is working? Well, that is the question that Ronan will be replying to here shortly. But first, I'd like to thank you for listening. Thank you.